Welcome to the Emotional Balance Sheet, the go-to podcast for parents with multiple kids, especially those with twins, triplets, or more, who are navigating the maze of modern family life and personal finance. Whether you're overwhelmed by education or retirement planning, parenting dilemmas, career transitions, or trying to define your purpose and plan, we're here to guide you with empathy, encouragement, and expertise. Hosted by Paul Fenner, founder of Tama Capital, a certified financial planner and parent to 4 kids, including a set of triplets. Our podcast is your ally in the quest for financial peace of mind, proving that money matters, but family comes first. Subscribe now and join our community of empowered parents at tamacapital.com. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Tama may retain positions in the securities discussed in this podcast.
What does comprehensive financial planning even mean? At Tama Capital, it means a family office where lifestyle planning such as retirement, college, portfolio management, and tax prep and planning are all under one umbrella. But it goes beyond numbers. We focus as much on the emotional side of financial planning as we do on the financial side. We get you. We understand your challenges of building a family, business or career, and a healthy life. We are devoted to wealth planning for families like yours because we are you. Learn how our family can help your family by visiting tamacapital.com. Hello, everyone, and welcome to 2025. This is the first podcast of the new year. I took a couple weeks off over the holidays to kind of regroup, recharge, spend some time with Teresa and my kids, and it was definitely time well spent, although I did squeeze in some work time here and there. I thought I would start today with this new year, talking a little bit about what happened in the markets in 2024, just as a kind of a brief precursor that I think sets us up for maybe what to think about or expect in 2025. And just remember, I do not make any forecasts or predictions on how the equity markets will fare from year to year. But I get a lot of great research from DataTrack. Nick Colas and Jessica Rabe over there, who are the 2 founders, send out a email with all sorts of market and economic information 5 days a week that I scour through, and it's a big component of what I do on the portfolio management side here at Tama. And so one of the last pieces of information they send out is what were the key components that made up the year. And so I'm going to look at some of my notes that I made. So there were 252 trading days in 2024. Of those, 143 days were positive return, and 109 were negative. And I'm talking about the S&P 500 index, not the Dow or the NASDAQ, just the S&P 500. And the S&P was up around 23% for the year. But like I just mentioned, there were 143 positive days. But what if I told you that there were only 16 that really made up that increase in the S&P 500? 16. So of 252 days in total, 143 were positive, and of that, 16 were the most critical. And what's interesting in looking at the numbers that Nick and Jessica had sent over is that typically every month there's 1 or 2 days from 2024 that stood out. And they stood out for all kinds of different reasons. But the other thing that I kind of noticed in going through the data that I'm looking at right now is there were 2 months that didn't have a significant positive return. And those 2 months were March and actually 3. March, October, and then ironically December. And December was actually weaker this year than most. You may hear of the Santa Claus rally that happens the last 5-day trading days of December, and the first 2 of the new year was actually down this year. So I'll be watching that because sometimes that could be a telltale sign, if you will, to see how the rest of the new year will go. But we're only a few trading days in. But a couple things I want to point out is, so why were these 16 days that important? Like, what happened on those 16 days to make the markets go up? And in true market fashion, there's no consistency. There's no rhyme or reason. I'm just looking at some of these. One was NVIDIA announces, a new AI chip in January. In February, the day after the first Fed meeting of the year, the S&P dropped suddenly and then it rebounded back suddenly. So a lot of things that we saw when we had like these really minor pullbacks in 2024, they were met with really sharp rallies over the next couple days. Some of it was economics. In May, a weaker than expected jobs report sent the stock market in rally mode because they were hoping for additional Fed rate cuts, which did end up happening at the end of the year or towards the end of the year. August was really strong. If you remember August, the first week, we were down around 9%-ish, if you will. And then we had this snapback rally. So like August 8th, 13th, and 15th, those 3 days alone, the S&P 500 was up, 5.5%, 6% over, those 3 days. And then, of course, in November, we had the election, Republican sweep, and on November 5th and 6th were two of the best days of the trading year. Actually, November 6th, the S&P 500 was up 2.5%, which made it the best day of the year. So what do we take away from all of this? I think first and foremost, it goes to prove, and this is data that's tried and true almost every year, is that there's always a really small subset of days that make up either the positive return of the year or the negative return of the year. And you never can predict what those days are. So that's why it's really important to know what your wealth management plan is and how your portfolio management plan supports that, so that when things go awry or things are going really well, you know the course that you need to be on. And that's part of the one of the biggest factors when it comes to portfolio management is just the behavioral finance side of it. Being able to trust in your process, have conviction, sometimes have strong convictions held loosely. But the point I'm trying to make here is that you cannot predict what days these are going to be. So you've got to be in the market. We're never all in from a portfolio management standpoint at Tama. I'm never all in or all out of the market. I think there's still a misconception of people have when it comes to portfolio management. It's more like tweaking in dials, like little adjustments here and there throughout the year. And asset allocation over the last, I'd say, 5 to 10 years has become such a bigger, more important component of portfolio management returns than picking individual stocks or bonds or ETFs or mutual funds. It's having that dial turned into knowing when to be more aggressive or more defensive in the markets. So, this year, we've now had back-to-back years of 20% returns. And there's still a lot of people out there in the US economy that do not feel that wealth creation. There's still a lot of people that are struggling from an inflation standpoint, from a job standpoint. There's always going to be these highs and lows. And what I try to do in managing portfolios is take that off of the table, to be able to tell the families that I work with that this is where we're at, this is what I'm doing, and this is why. And look, it doesn't always work out the way I intend it to, but that's the cost of, or the price of entry into the markets, is knowing that there's going to be ups and downs. But over the long term, if I was showing this chart that I show all my clients, the day that I was born, May 11th, 1976, up until now, you see that the markets go from, bottom left to upper right with, a lot of noise and chop during that, last 48 years now. Sometimes it's hard to say that. But again, if I'm trying to wrap this up, my point is, again, we never know what these days are going to be. So we need to make sure that we're in the market consistently and adhering to the strategy from a portfolio management standpoint that supports your wealth management plan, your purpose, and your objectives, whether that's retirement, college planning, you name it. Having that alignment is really key. So where does this leave us for 2025? As I mentioned earlier, I have no idea. Right now, the momentum is still strong as far as animal spirits go. A lot of people, as I just mentioned, we've had now back-to-back 20% year gains. So I think naturally people think, well, it can't continue to last. Well, history shows it can. And this is where, if you really look into the data, which is what I do, you will see that just because we've had 2 great years back to back doesn't mean 2025 is going to be down. It can certainly be more choppy. One thing we did not get last year, which we typically get once a year, is a 10% correction. We almost got that in August. So we have a new administration. There's lots of things going on in politics in D.C., whether we're going to get these tariffs or not. If corporate earnings trends are going to continue to hang in there like they've been the last couple years. So I think the key thing that have a watchful eye on is, again, going back to this term called animal spirits. How much are people bidding up prices of publicly traded stocks and the valuations multiples that people are putting on those? If we're continuing to see that expand without underlining corporate earnings support, then that should make us all a little bit nervous, because valuations historically right now are trending on the higher side. So that's one thing that I always keep in front of me and it's on my radar, is taking the temperature of the market. So again, I have no idea how 2025 is going to finish. I think everybody consensus on Wall Street is saying, 8 to 12%, returns on equity this year. Again, I don't know if we get there or not, but right now, most of my asset allocations are still about 5% under where I would normally have them. So if you would be in a 70-30 equity or asset allocation, 70% equities, 30% fixed income. Like right now, my typical portfolio for you would be 65% equities, 35% fixed income. So I'm slightly under that. But again, it goes back to my point where my portfolio strategy is never all in or ever all out. So hopefully you found this helpful. If you take away anything from this point, this conversation, is diversity matters and being in the market consistently matters. It doesn't matter if you're starting out, if you're 48 like I am, or you're like many of the retired families that I work with. They just have a lot lower asset allocation because they don't need to take additional risk. If you've enjoyed this conversation, could you do me a favor? Do you know anyone else who would enjoy these types of conversations where we talk about the intersections of our emotional and financial lives? Because if you do, it's actually going to help both of us. Could you share this conversation with someone? They will think you're great because you just gave them this terrific podcast, and it helps me grow my audience. Or you can tell them to go to tamacapital.com. Thank you so much, and we'll see you next time.